The ABC of Money, A Beginner's Guide to Financial Freedom. Written by Ronnie Rowland. Published by Growth Literacy Lounge. Introduction. The Power of Understanding Money. Imagine waking up one morning to find that the money in your pocket has lost half its value overnight. Your savings, plans for the future, and financial security are all thrown into chaos. This isn't a scene from a dystopian novel, it's a reality that has happened to many people throughout history. Most of us take the stability of money for granted, yet it's one of the most critical aspects of our economic lives. Understanding the true nature of money, why it exists, and how it works is not just for economists and bankers, it's for everyone. From the farmer in the field to the factory worker, the entrepreneur, and the retiree, money plays a vital role in our daily lives. This book is your guide to understanding money in a simple, engaging, and profoundly impactful way. In the following chapters, we'll journey through money's history, evolution, societal impact, and today's critical choices. We'll uncover the reasons behind monetary stability and instability, drawing lessons from the past to inform our present and future decisions. Together, we'll delve into the importance of sound economic policies and how they affect each of us, focusing on the gold standard versus other monetary systems. Let's start this journey by understanding the foundation of money, what it is, why it exists, and how it has evolved. This is not just a history lesson, it's the beginning of a transformative understanding that will empower you to navigate the complexities of modern finance with confidence and clarity. Join our community today to unlock a world of endless discovery and inspiration. Hit the subscribe button to join a movement revolutionizing how we learn and grow. Comment below, and give us a like. Share your book preferences in the comments so we can tailor our content to your interests. Let's embark on this journey of learning and growth together. Join us and be a catalyst for change. Let's begin. Chapter 1. The Foundation of Money. Once upon a time, in a small village nestled in the hills, people lived by growing their food, making their clothes, and building their own homes. Life was simple, but there was one central inconvenience: barter. If a farmer needed a new pair of shoes, he had to find a shoemaker who wanted his vegetables. This system worked, but it was cumbersome and inefficient. As the village grew, people began to specialize in different trades. The shoemaker no longer needed to produce his food, he could trade shoes for vegetables. However, finding the exact match for trades became increasingly difficult. This is where money, in its earliest forms, began to play a crucial role. Money started as anything widely accepted in exchange for goods and services. In some regions it was cowrie shells, in others it was salt, livestock, or even large stone wheels. These items had intrinsic value and were relatively scarce, making them suitable as a medium of exchange. As societies evolved, so did the concept of money. Metals like gold and silver became the preferred medium of exchange. These metals had all the qualities needed for money. They were durable, divisible, portable, and had intrinsic value. The gold standard emerged to ensure that the value of money remained stable. Gold was universally valued, unlike other commodities, providing a reliable basis for trade and economic growth. Think about the last time you used cash or a credit card. You likely didn't consider the complex history behind that transaction. But imagine if we still had to trade items directly. Your morning coffee might require you to bring a bag of apples to the barista. Understanding the evolution of money helps us appreciate the convenience and stability we often take for granted. The transition to a gold-based monetary system wasn't arbitrary. It resulted from centuries of trial and error, economic turmoil, and the collective wisdom of societies worldwide. Gold's unique properties made it the backbone of stable economies, allowing for predictable trade and growth. As we explore this history, we'll see why maintaining a stable monetary system is crucial for our economic health. But what happens when this stability is threatened? History is replete with examples of societies that faced economic disaster when they debased their currency or moved away from stable standards. These lessons are not just academic, they have real implications for our financial security today. Imagine living in a world where the value of your money could change daily. This was the reality for many before the advent of modern monetary systems. By understanding the foundation of money, we can better navigate the financial challenges we face today and advocate for policies that protect our economic future. The next chapter will delve deeper into why money matters to everyone. We'll explore its impact on different societal groups, from farmers to factory workers, and how understanding money can empower us all. Join me as we uncover the true power of money and its role in our everyday lives. Chapter 2: Why Money Matters to Everyone. Money is often considered a complex and distant concept reserved for economists and bankers. However, money profoundly impacts every aspect of our lives, from the food we eat to the clothes we wear, and even the education we receive. It's the invisible thread that weaves the fabric of our daily existence. This chapter will explore why money matters to everyone, regardless of occupation or social status. By understanding the role of money, we can better appreciate its importance and make informed decisions that enhance our financial well-being. Consider a farmer in the countryside. He works hard to grow crops, which he sells to provide for his family. The price he gets for his crops depends on the currency's stability. If the money he receives loses value quickly, he can't afford the same goods and services, leading to financial strain. On the other hand, a stable currency ensures that the farmer's hard work translates into a consistent and reliable income. Similarly, think about a factory worker. She earns a wage that she uses to support her household. If the value of money fluctuates wildly, her purchasing power decreases, making it difficult to budget and save for the future. Stable money allows her to plan her finances, save for her children's education, and ensure a secure retirement. Imagine walking into a grocery store and finding that the prices of essential items have doubled overnight. The frustration and anxiety that come with such instability are palpable. Now, think about the relief and confidence of knowing that your money retains its value over time. This stability is not just a financial concept, it translates into peace of mind and a better quality of life. Historical evidence supports the need for stable money. Countries with stable currencies have experienced consistent economic growth and improved living standards. On the contrary, those with unstable currencies often face economic turmoil, high inflation, and widespread poverty. By examining these examples, we see the undeniable link between monetary stability and societal well-being. But what happens when a country loses control over its currency? Inflation can spiral out of control, leading to economic collapse. Zimbabwe, for instance, experienced hyperinflation, where the prices of goods doubled every few days. People's savings were wiped out, and the economy crumbled. Such scenarios highlight the importance of maintaining monetary stability to avoid devastating consequences. To make this concept more relatable, let's use an everyday example. Imagine saving money for a year to buy a new car. If the currency is stable, you know exactly how much you need to save and can plan accordingly. However, if the currency is unstable, the price of the car could increase dramatically, making it nearly impossible to achieve your goal. Money stability simplifies our lives and makes our financial aspirations achievable. In the next chapter, we will explore the specifics of the gold standard. We will explore why gold has been historically chosen as the preferred basis for money and how it has contributed to economic stability. We will uncover the fascinating journey of gold as a monetary standard and why it remains relevant today. Join me as we delve into the golden history of money and its implications for our financial future. Chapter 3: The Gold Standard Explained. Historically, various items have been used as money, from cowrie shells to livestock. However, gold has consistently stood out as the preferred basis for cash. The gold standard, where the value of a country's currency is directly linked to a specific amount of gold, has played a crucial role in ensuring economic stability. But what makes gold so particular? This chapter will explore the characteristics that make gold an ideal monetary standard. We'll delve into the history of the gold standard, its impact on economies, and why it remains a symbol of financial stability. Gold has several unique properties that make it suitable as a basis for money. It is durable, meaning it does not rust or tarnish over time. It is divisible, allowing it to be broken down into smaller units without losing value. Gold is also portable, meaning significant value can be transported in small quantities. Most importantly, gold has intrinsic value, which means it is valuable in and of itself, beyond just being used as money. These properties have made gold a reliable standard for centuries. Countries that adopted the gold standard experienced more excellent economic stability, as the value of their currency was tied to a tangible and universally valued asset. This stability encouraged investment, fostered economic growth, and protected savings from the ravages of inflation. Think about gold jewelry. Gold is prized for its beauty and value, even in its ornamental form. This intrinsic value means that gold is always in demand, not just as money but also in industries and for personal adornment. This constant demand helps maintain its value over time, unlike paper money, which can be printed excessively and lose value rapidly. Imagine living in a time when your savings are in gold coins. These coins have a consistent value, giving you confidence in your financial future. Contrast this with the uncertainty of holding paper money that might lose value due to inflation or poor economic policies. Generations have cherished the security that comes with gold. The gold standard's historical success is well documented. During the 19th and early 20th centuries, countries with the gold standard enjoyed stable prices and robust economic growth. For example, the United States adopted the gold standard in 1879 and experienced one of its most significant industrial expansion and innovation periods. Even during times of crisis, gold has proven to be a haven. During the Great Depression, countries that adhered to the gold standard for more extended periods experienced less severe economic contractions than those that abandoned it early. These historical examples underscore gold's enduring strength and reliability as a monetary standard. However, the transition from the gold standard in the 20th century brought significant changes. Governments found the constraints of the gold standard limiting, especially during economic stress, such as wars or recessions. The shift to fiat money, where a physical commodity does not back currency, allowed for more flexibility and introduced the risk of inflation and currency devaluation. We must consider history's lessons. While the gold standard has limitations, its stability starkly contrasts with the volatility in some fiat currency systems. Understanding these dynamics helps us appreciate the importance of stable monetary policies and the potential risks of abandoning them. Imagine you are building a house. A foundation made of gold is like using the most durable and reliable materials available. You know your home will stand firm for generations. Now, imagine a foundation of paper easy to build with but prone to damage and decay. The gold standard is the strong foundation that has supported stable economies, while fiat money systems require careful management to avoid collapse. In the next chapter, we'll examine the fluctuating nature of silver and other metals. While valuable, we'll explore why these metals do not provide the same stability as gold. Join me as we uncover the historical and economic reasons behind silver's volatility and its impact on economies. Understanding these differences will further illuminate why gold has been the preferred choice for monetary stability. Chapter 4. The fluctuating nature of silver. While gold has long been revered for its stability and intrinsic value, silver has also played a significant role in monetary history. However, silver's story is one of greater volatility and unpredictability. Despite its usefulness and value, silver's fluctuating nature has often made it a less reliable currency standard. This chapter will explore silver's volatility, historical use as money, and the economic consequences of relying on silver as a monetary standard. By understanding these dynamics, we can appreciate why silver, despite its many benefits, has often been overshadowed by gold in stable financial systems. Silver, like gold, is durable, divisible, and portable. It has been used for centuries for coins, jewelry, and industrial applications. However, silver's supply is more abundant, and its value is more variable than gold. This abundance can lead to significant price fluctuations influenced by market demand and technological advances in mining and refining. Historically, countries that relied heavily on silver experienced greater economic instability than those on the gold standard. The increased supply of silver often led to inflation, as more money chased the same amount of goods and services. This inflation eroded savings and purchasing power, leading to economic hardship for many. Imagine saving your hard-earned money in silver coins, only to find that the value of those coins fluctuates wildly. Your savings might buy you a new home one year, but it might not cover necessities the following year. This uncertainty makes it difficult to plan for the future and undermines financial security. Consider the experiences of farmers and workers in countries that use silver as their primary currency. They often faced unpredictable changes in their purchasing power, making it challenging to budget for their families or invest in their businesses. The stability provided by gold was a stark contrast, offering a reliable measure of value over time. The historical record is clear. Nations that based their monetary systems on gold experienced more consistent economic growth and stability. For instance, during the 19th century, many European countries and the United States adopted the gold standard, leading to a period of relative economic stability and prosperity known as the classical gold standard era. In contrast, countries that used silver, such as China and several Latin American nations, faced more frequent economic crises and inflation. The Mexican peso, for example, suffered from significant depreciation during periods when silver was the primary standard, leading to financial uncertainty and hardship for its citizens. The volatility of silver is not just a historical curiosity, it has real implications for today's economic policies. Learning from the past is essential as we consider the merits of different monetary systems. The instability caused by silver's fluctuating value serves as a cautionary tale for those advocating for its return as a primary standard. While silver has many uses and benefits, its role in a stable monetary system is limited. History's lessons remind us that the pursuit of stability in money requires careful consideration of the underlying assets and their long-term reliability. Imagine planning a family budget with a currency that changes value unpredictably. One month, you might afford a nice vacation, but the next, you struggle to pay for groceries. This unpredictability is akin to managing finances with silver as the primary standard. The stability and predictability of gold provide a solid foundation, much like building a house on the rock rather than shifting sand. In the next chapter, we will explore the perils of debased currency. We'll uncover historical examples of countries that faced economic disasters when they tampered with the value of their money. Understanding these risks will highlight the importance of maintaining a stable and honest monetary system. Join me as we delve into the consequences of debasing currency and the lessons we can learn to protect our financial future. Chapter 5. The Perils of Debased Currency. Throughout history, the temptation to debase currency, reducing the value of money by decreasing the amount of precious metal in coins, has led to economic turmoil. Governments facing financial crises or seeking short-term gains have often resorted to debasement, with disastrous consequences. Understanding the perils of debased currency helps us appreciate the importance of maintaining a stable and honest monetary system. This chapter will explore the historical examples of currency debasement, its economic impacts, and the lessons we can draw from these events. By examining the past, we can better understand today's vital need for sound monetary policies. Debasing currency might seem like an easy fix for governments in financial trouble. Reducing the precious metal content in coins can produce more money without additional resources. However, this practice undermines trust in the currency and leads to inflation. The value of money decreases, prices rise, and citizens' purchasing power erodes. Take, for example, the Roman Empire. The empire began to debase its silver coins to fund its expansive military campaigns, reducing their silver content over time. This led to rampant inflation and a loss of public confidence, ultimately contributing to the empire's economic decline. The lesson is clear: debasing currency for short-term gains results in long-term economic pain. Imagine you've been saving diligently for years, only to wake up one day and find that your money is worth significantly less. This was the reality for many during periods of currency debasement. People saw their life savings dwindle, making it harder to afford necessities or plan for the future. Consider the story of a craftsman in 14th century England. He earns a steady income, but when the government starts debasing the currency, the value of his earnings plummets. Prices for goods and services skyrocket, and his hard work no longer provides the same level of financial security. This personal turmoil highlights the devastating impact of debased currency on individuals and families. Historical evidence consistently shows that debased currency leads to economic instability. England's experience in the 16th century under Henry VIII is another notable example. Henry debased the English coinage to fund his extravagant lifestyle and wars, resulting in severe inflation and economic distress. Subsequent rulers made significant efforts to restore confidence in the currency and stabilize the economy. Similarly, in Weimar Germany after World War I, excessive printing money to pay reparations led to hyperinflation. The value of the German mark plummeted, causing widespread economic chaos and hardship. These historical precedents underscore the critical importance of maintaining the integrity of a nation's currency. The temptation to debase currency or engage in excessive money printing is not just a relic of the past. modern economies face similar risks, especially during financial crises. If not managed carefully, quantitative easing and other monetary policies can lead to inflation and loss of confidence in the currency. As we navigate contemporary economic challenges, it is essential to remember the lessons of history. Debasing currency undermines the foundational trust that economies depend on. Sound monetary policies that preserve the value of money are crucial for long-term economic health and stability. Think of currency as the foundation of an economy. Just as a house built on a weak foundation eventually collapses, an economy built on debased currency will face inevitable instability. Ensuring that money retains its value is like reinforcing your home's foundation, providing security and stability for the future. The next chapter will examine modern monetary systems and the ongoing debate between different standards, including gold, silver, and fiat money. We'll explore the pros and cons of each system and consider how these choices impact economic stability. Join me as we delve into contemporary monetary policies and their implications for our financial future. Understanding these modern dynamics will equip us to advocate for policies that ensure economic stability and prosperity. Chapter 6. Modern monetary systems. In today's world, the monetary system is more complex and varied than ever before. Different countries have adopted other standards, ranging from gold-backed currencies to fiat money. Understanding these systems and their implications is crucial for navigating the global economy. This chapter will explore the pros and cons of various monetary systems, including the gold standard, silver standard, and fiat money, and how they impact economic stability. As we have seen, the gold standard provided a reliable foundation for monetary stability. However, in the 20th century, many countries shifted away from gold-backed currencies to fiat money currency, that a government has declared to be legal tender, but is not backed by a physical commodity. This shift was driven by the need for greater flexibility in monetary policy, especially during economic crises. Fiat money allows governments to manage the money supply and respond dynamically to economic conditions. For example, during the Great Depression, the United States abandoned the gold standard to implement policies that expanded the money supply, aiming to stimulate the economy. Similarly, during the 2008 financial crisis, central banks worldwide used quantitative easing to inject liquidity into the economic system. Imagine you're a small business owner. You might struggle to get loans during a recession because banks are cautious about lending. With a fiat money system, the central bank can lower interest rates and increase the money supply, making it easier for you to get the credit you need to keep your business afloat. This flexibility can help mitigate the worst effects of economic downturns. However, the downside of fiat money is the risk of inflation. When too much money is printed without corresponding economic growth, the value of money can decrease, leading to higher prices for goods and services. This was the case in Zimbabwe in the late 2000s, where hyperinflation rendered the national currency virtually worthless. Historical and contemporary evidence shows the benefits and risks of various monetary systems. While the gold standard provided long-term stability, it also constrained economic policy during crises. On the other hand, fiat money offers flexibility but requires careful management to avoid inflation and maintain public confidence. For example, the Bretton Woods system, established after World War II, created a framework for international monetary cooperation. It linked currencies to the US dollar, which was convertible to gold. This system provided stability and facilitated global trade. However, as economic conditions evolved, the rigidities of the system led to its collapse in the 1970s, giving way to the current era of floating exchange rates and fiat currencies. The move away from commodity-backed money to fiat systems has not been without challenges. Vigilant monetary policy is paramount. Central banks must balance the goals of stimulating economic growth and controlling inflation. Failure to manage this balance can lead to financial instability, as seen in various instances of hyperinflation and currency crises. Consider the Eurozone crisis in the early 2010s. Countries using the euro faced significant economic challenges, partly because they could not independently adjust their monetary policies to suit their national economic conditions. This crisis highlighted the complexities and risks associated with shared fiat currencies and the importance of sound fiscal and monetary policies. Think of the monetary system as the brakes and accelerator of a car. The gold standard is like a car with only a brake pedal, excellent for stability but lacking flexibility. Fiat money adds to the accelerator, allowing for greater control and responsiveness. However, just as driving requires skill to balance acceleration and braking, managing a fiat money system requires careful oversight to maintain economic stability. The next chapter will delve into the importance of stability in the monetary system and how it benefits economies and individuals. We'll explore how stable money policies foster economic growth, protect savings, and enhance financial security. Join me as we uncover the vital role of stability in creating a prosperous and resilient economy. Understanding this will further highlight why sound monetary policies are essential for our financial well-being. Chapter 7. Stability, the cornerstone of prosperity. Stability in the monetary system is not just a technical term used by economists, it is the bedrock of economic prosperity and personal financial security. Stable money allows for predictable pricing, sound investments, and steady economic growth. This chapter will explore why stability is so crucial, how it impacts different aspects of the economy, and why it is essential for every individual. When money maintains a stable value, it provides a reliable measure for saving, investing, and planning for the future. Imagine a world where the value of your savings does not erode over time due to inflation. You can prepare for significant life events, such as buying a house or retiring, with confidence that your money will retain its purchasing power. Stability in the monetary system fosters investor confidence. Businesses are more likely to invest in new projects, hire employees, and expand operations when they are assured that volatile currency fluctuations will not undermine the value of their investments. This, in turn, drives economic growth, creating more jobs and improving living standards. Think about your finances. If you knew that the money you save today would have the same purchasing power when you retire, you would be more inclined to save and invest. This assurance allows you to plan for your future, whether funding your children's education, starting a business, or ensuring a comfortable retirement. Consider the experiences of families in countries with unstable currencies. Hyperinflation, as seen in countries like Venezuela and Zimbabwe, wipes out savings and makes everyday purchases a struggle. In contrast, countries with stable monetary policies provide their citizens with a secure environment in which to build and preserve wealth. Historical evidence strongly supports the benefits of monetary stability. During the post-World War II era, countries with stable monetary policies experienced significant economic growth and development. Despite its eventual collapse, the Bretton Woods system initially provided a stable environment facilitating global trade and investment. Conversely, periods of instability, such as the hyperinflation in Weimar Germany or the Latin American debt crises of the 1980s, highlight the devastating effects of monetary instability. These events led to economic collapse, social unrest, and severe hardship for ordinary citizens. The lessons from these periods underscore the importance of maintaining stable and sound monetary policies. While the benefits of stability are clear, achieving and maintaining it requires careful management and prudent policies. Central banks and governments play a crucial role in ensuring that monetary policies promote stability. This involves controlling inflation, managing interest rates, and regulating the money supply. We must also consider the global interconnectedness of today's economy. Instability in one country can have ripple effects worldwide. The 2008 financial crisis, for example, started in the United States but quickly spread, affecting global economies. This interdependence makes it even more critical to maintain stable national and international monetary policies. Imagine you are building a financial house. A stable monetary system is like a solid foundation that ensures your house stands firm, regardless of the weather. Without this foundation, no matter how well you build the rest of your home, it will always be at risk of collapsing. Money stability provides the assurance needed for financial security and growth. In the next chapter, we will delve into historical lessons on money. We'll examine critical events that shaped our understanding of monetary policies and explore how past experiences can inform our present and future decisions. Join me as we uncover history's valuable lessons, shedding light on the principles that can guide us toward a more stable and prosperous economic future. Chapter 8. Historical Lessons on Money. History offers a wealth of knowledge about the successes and failures of different monetary policies, By examining key events that shaped our understanding of money, we can gain valuable insights into what works and what doesn't. These lessons from the past can guide us in making informed decisions to ensure a stable and prosperous economic future. This chapter will explore significant historical episodes, from ancient to modern times, highlighting the importance of sound monetary policies. We will analyze these events to draw practical lessons that remain relevant today. Consider the Roman Empire, once a beacon of economic strength and stability. To fund its expansive military campaigns, the empire gradually debased its currency by reducing the silver content in its coins. This led to inflation and a loss of public confidence and contributed to the empire's eventual decline. The lesson here is clear: tampering with the intrinsic value of money for short-term gains leads to long-term economic ruin. Fast forward to the 18th century, when John Law's Mississippi scheme in France promised vast wealth through paper money and speculative investments. Initially, it fueled economic growth, but as the scheme unraveled, it led to hyperinflation and a catastrophic collapse. This episode underscores the dangers of speculative bubbles and the importance of backing currency with real value. Imagine living in Germany during the Weimar Republic in the 1920s. Hyperinflation caused prices to double every few days, wiping out savings and making it nearly impossible to afford necessities. People would rush to spend their money as soon as they received it, knowing its value would diminish rapidly. This historical moment vividly illustrates the human toll of monetary mismanagement. Think about the impact of such instability on ordinary people: families unable to buy food, workers demanding to be paid several times a day, and life savings becoming worthless overnight. These personal stories highlight why maintaining stable money is crucial for societal well-being. The 20th century also offers positive examples of effective monetary policies. The Bretton Woods system provided a framework for international financial stability during the post-World War II era. The system fostered economic growth and facilitated global trade by pegging currencies to the US dollar, which was convertible to gold. Although it eventually collapsed, the Bretton Woods system demonstrated the benefits of a cooperative and stable monetary framework. More recently, the response to the 2008 financial crisis shows how coordinated monetary policies can mitigate economic downturns. Central banks worldwide implemented measures like quantitative easing to stabilize financial markets and promote economic recovery. These actions, while controversial, helped prevent a more profound global depression. While history provides clear lessons, it also warns us of complacency. The recent rise of cryptocurrencies, for example, echoes past speculative bubbles. While innovative, these digital currencies are highly volatile and lack the stability of traditional money. As we embrace new financial technologies, we must remain vigilant and ensure they do not undermine economic stability. We must also consider the impact of global interconnectedness. The 1997 Asian financial crisis, triggered by currency devaluations, spread rapidly across countries, highlighting the risks of economic contagion. These events remind us that sound monetary policy must be maintained locally and with an awareness of global implications. Imagine history as a vast library filled with economic triumphs and failure stories. Each story offers a lesson, a warning, or an inspiration. By reading these stories, we arm ourselves with knowledge that can prevent us from repeating past mistakes. Just as we learn from personal experiences, we must also learn from humanity's collective experiences to build a stable and prosperous future. The next chapter will explore the connection between personal finance and monetary policy. We'll see how national monetary decisions affect individual financial health and what you can do to protect your savings and investments. Join me as we bridge the gap between macroeconomic policies and personal financial strategies, empowering you to navigate the complexities of the modern economic landscape. Chapter 9: Personal Finance and Monetary Policy. Monetary policy might seem like an abstract concept far removed from everyday life, but it directly impacts personal finance. Understanding how national monetary decisions affect your financial health can empower you to make better choices. This chapter will explore the relationship between personal finance and monetary policy, providing practical tips to protect your savings and investments in various economic climates. Consider how interest rates, a vital monetary policy tool, influence your finances. When central banks raise interest rates, borrowing costs increase, making loans and mortgages more expensive. Conversely, when rates are lowered, borrowing becomes cheaper, encouraging spending and investment. For savers, higher interest rates mean better returns on savings accounts and fixed income investments, while lower rates can erode these returns. During periods of high inflation, money's purchasing power decreases, prices for goods and services rise, and the value of savings diminishes. Understanding the factors that drive inflation and how monetary policy aims to control it can help you make informed decisions about saving, investing, and spending. Imagine you've been diligently saving for a down payment on a house. You're almost there, but then inflation spikes and the prices of homes soar beyond your reach. This frustrating scenario illustrates how inflation, driven by national monetary policy, can affect personal goals. You can better plan for such contingencies by staying informed about economic conditions. Think about your retirement savings. If inflation is high and interest rates are low, the actual value of your retirement fund may erode over time. This uncertainty makes it crucial to diversify your investments and seek assets that can hedge against inflation, such as real estate or commodities. Historical evidence shows that understanding and anticipating monetary policy trends can significantly enhance personal financial management. For instance, during the 1970s, many investors protected their wealth by investing in gold and real estate, which held their value better than fiat currency during the high inflation of that period. Similarly, savvy investors in the early 2000s capitalized on low interest rates by locking in long-term mortgages and investing in equities. Financial experts consistently recommend diversification to mitigate risks associated with monetary policy changes. By spreading investments across different asset classes, you can reduce the impact of any single economic event on your overall portfolio. While it's essential to understand how monetary policy affects personal finance, it's equally vital to avoid overreacting to short-term fluctuations. Economic cycles are inevitable, and panic-driven financial decisions can be detrimental. Maintaining a long-term perspective and a well-thought-out financial plan is essential for weathering economic storms. Additionally, the rise of cryptocurrencies presents both opportunities and risks. While they offer potential as a hedge against traditional monetary systems, their volatility makes them a risky addition to a personal finance strategy. Understanding the balance between innovative investments and traditional assets is crucial for financial stability. Think of your finances as a garden. Monetary policy is the weather. It can bring sunshine that helps your garden grow, or storms that threaten to wash away your hard work. By understanding the forecast and preparing accordingly, you can protect your garden and ensure it thrives regardless of the weather. Practical tips for navigating monetary policy. Stay informed. Follow economic news and central bank announcements. Understanding current monetary policy can help you anticipate changes in interest rates and inflation. Diversify investments. To reduce risk, spread your investments across various asset classes such as stocks, bonds, real estate, and commodities. Protect against inflation. Consider investing in assets that typically appreciate during inflationary periods, like real estate or precious metals. Review debt strategies. When interest rates are low, consider refinancing high-interest debt to lower rates. Conversely, be cautious about taking on new debt when rates are high. Plan for the long term. Avoid making hasty financial decisions based on short-term market movements. Stick to a long-term economic plan tailored to your goals and risk tolerance. In the next chapter, we will explore the future of money and currency. We'll delve into emerging trends, such as digital currencies and technological innovations, and consider their potential impact on the global economy and personal finance. Join me as we navigate the evolving landscape of money, preparing ourselves for the changes and opportunities that lie ahead. Understanding these developments will equip us to make informed financial decisions in an increasingly digital world. Chapter 10. The Future of Money and Currency. The financial landscape is rapidly evolving, and the future of money is poised to look very different from what we know today. Digital currencies, blockchain technology, and other innovations are reshaping how we think about and use money. Understanding these emerging trends is crucial for navigating the changing economic environment and making informed financial decisions. This chapter will explore the rise of digital currencies, the potential impact of blockchain technology, and other technological advancements transforming the finance world. We will also consider the implications of these changes for the global economy and personal finance. Digital currencies like Bitcoin and Ethereum have garnered significant attention in recent years. Unlike traditional fiat currencies, these digital assets operate on decentralized networks using blockchain technology. This decentralization promises greater security, transparency, and efficiency in financial transactions. Proponents argue that digital currencies can democratize finance, reduce transaction costs, and offer a hedge against inflation and currency devaluation. However, digital currencies also pose risks and challenges. Their value can be highly volatile, and regulatory uncertainty adds to their speculative nature. Moreover, the environmental impact of cryptocurrency mining has raised concerns. Understanding these pros and cons is essential for making informed decisions about investing in and using digital currencies. Imagine you're an early adopter of Bitcoin. You've watched its value skyrocket and plummet, experiencing both the thrill of potential gains and the anxiety of sudden losses. Your journey highlights the volatility and excitement surrounding digital currencies. For many, investing in these assets is akin to navigating uncharted waters filled with opportunities and uncertainties. Consider the story of a small business owner who begins accepting cryptocurrency payments. This decision opens new markets and attracts tech-savvy customers, but it also requires adapting to new technologies and managing the risks of price volatility. These real-world examples illustrate the practical implications of integrating digital currencies into everyday life. Blockchain technology, the backbone of digital currencies, is more than just a buzzword. It offers a secure and transparent way to record transactions, making it a potential game-changer for various industries beyond finance. From supply chain management to healthcare, blockchain's ability to provide verifiable and tamper-proof records can revolutionize how data is managed and shared. Central banks are also exploring the concept of central bank digital currencies (CBDCs). These digital versions of national currencies aim to combine the benefits of digital transactions with the stability and trust associated with traditional currencies. Countries like China are already piloting CBDCs, while others, including the United States and the European Union, are researching their potential. While the future of money holds exciting possibilities, it also comes with significant challenges. Regulatory frameworks must adapt to ensure digital currency's safe and fair use. Privacy, security, and environmental sustainability issues must be addressed to build trust and ensure long-term viability. We must also consider the potential societal impacts of these changes. As digital currencies become more prevalent, those without access to technology could be left behind, exacerbating existing inequalities. Ensuring that the benefits of financial innovation are broadly shared will be a crucial task for policymakers and industry leaders. Think of the financial world as an ever-evolving ecosystem. As new species can disrupt and transform an environment, digital currencies and blockchain technology reshape the economic landscape. By staying informed and adaptable, we can thrive in this new environment, taking advantage of opportunities while managing risks. Practical tips for engaging with the future of money. Educate yourself. Learn about digital currencies and blockchain technology. Understanding the basics will help you navigate this new financial landscape. Start small. If you're interested in investing in digital currencies, start with a small amount you can afford to lose. This approach allows you to learn without taking on too much risk. Diversify investments. Don't put all your money into digital currencies. Maintain a diversified portfolio to spread risk. Stay updated. Follow news and developments in the digital currency space. Regulatory changes and technological advancements can significantly impact the market. Consider the long term. Like any investment, think about the long-term potential rather than seeking quick gains. The digital currency market is volatile, and patience can be rewarding. In the next chapter, we will explore the practical implications of monetary policy and its impact on everyday life. We'll look at how changes in interest rates, inflation, and other economic factors influence our financial decisions. Join me as we delve into the nitty-gritty of how monetary policy shapes our world, equipping you with the knowledge to make informed and strategic financial choices. Chapter 11. Practical implications of monetary policy. While often discussed in economic circles, monetary policy profoundly impacts our everyday lives. Changes in interest rates, inflation, and the money supply influence everything from the cost of borrowing to the price of groceries. Understanding these practical implications helps us make informed financial decisions and better navigate the economic landscape. In this chapter, we will explore how various aspects of monetary policy affect our daily lives. We will examine the influence of interest rates, inflation, and government fiscal measures on personal finance, and provide practical strategies to manage these impacts. Interest rates, set by central banks, are a powerful tool for influencing economic activity. When interest rates are low, borrowing becomes cheaper, encouraging spending and investment. This can stimulate economic growth. Conversely, high interest rates make borrowing more expensive, which can help control inflation but also slow down economic activity. For example, central banks often lower interest rates during economic downturns to encourage borrowing and spending. This policy aims to boost economic activity and reduce unemployment. On the other hand, during periods of rapid economic growth, central banks may raise interest rates to prevent the economy from overheating and to keep inflation in check. Imagine you are planning to buy a home. When interest rates are low, your mortgage payments will be lower, making homeownership more affordable. However, if interest rates rise, your monthly payments increase, making it more challenging to afford a home. Understanding these dynamics helps you make better decisions about when to buy or refinance a home. Consider the impact of inflation on your grocery bill. If inflation is high, the prices of goods and services rise, reducing your purchasing power. This means you can buy less with the same amount of money. By understanding the factors that drive inflation, you can better prepare for and mitigate its effects on your budget. Historical data shows how effective monetary policy can be in managing economic conditions. For instance, during the Great Recession of 2008, central banks worldwide slashed interest rates to near zero and implemented quantitative easing to inject liquidity into the financial system. These measures helped stabilize financial markets and set the stage for economic recovery. Similarly, under Chairman Paul Volcker in the late 1970s and early 1980s, the U.S. Federal Reserve raised interest rates sharply to combat runaway inflation. This painful but necessary action brought inflation under control and restored economic stability, demonstrating the critical role of monetary policy in managing financial challenges. While monetary policy is a powerful tool, it is not without its limitations and risks. Over-reliance on low interest rates can lead to asset bubbles, as seen in the housing market crash in 2008. Additionally, excessive money printing can devalue currency and lead to hyperinflation, as Zimbabwe experienced. Balancing monetary policy to promote sustainable economic growth without triggering instability is essential. Policymakers must consider the long-term impacts of their decisions and avoid short-term measures that could lead to future financial problems. Think of monetary policy as the thermostat of the economy. Just as you adjust the thermostat to maintain a comfortable temperature in your home, central banks adjust interest rates and money supply to maintain economic stability. Understanding these adjustments helps you anticipate changes in the economic climate and plan accordingly. Practical tips for navigating monetary policy changes. Monitor interest rates. Monitor interest rate trends. If you plan to borrow money, do so when rates are low. If rates are rising, consider locking in fixed-rate loans. Invest wisely. Consider investing in stocks or real estate during periods of low interest rates, which may offer better returns than savings accounts. When rates are high, fixed income investments like bonds can be more attractive. Protect against inflation. Diversify your investments to include assets that appreciate inflation, such as real estate or commodities. Build an emergency fund. A financial cushion can help you weather economic downturns and periods of high inflation. Stay informed. Follow economic news and central bank announcements to anticipate changes in monetary policy and adjust your financial strategies accordingly. In the next chapter, we will explore the role of government in monetary policy and economic stability. We'll examine how fiscal measures, regulations, and international cooperation influence the economy and your finances. Join me as we delve into the complex interplay between government actions and economic outcomes, providing a deeper understanding of how policies shape the financial landscape. Chapter 12. The government's role in monetary stability. Governments play a crucial role in shaping monetary policy and ensuring economic stability. Their actions, from fiscal measures to regulatory frameworks, directly influence the economy's health and, by extension, our finances. Understanding the interplay between government actions and economic outcomes is essential for navigating the complexities of the financial landscape. This chapter will explore how governments influence monetary policy and economic stability. We will examine their tools and strategies, the importance of regulations, and the role of international cooperation in maintaining a stable global economy. Fiscal policy involves government spending and taxation, and is a powerful tool for influencing economic activity. Governments can increase spending and cut taxes during economic downturns to stimulate growth. Conversely, reducing spending and raising taxes during rapid economic expansion can help cool the economy and prevent overheating. For example, during the Great Depression, the U.S. government implemented the New Deal, a series of programs and projects to revive the economy through increased public spending. More recently, during the COVID-19 pandemic, governments worldwide launched stimulus packages to support businesses and individuals, demonstrating the critical role of fiscal policy in managing economic crises. Imagine you are a small business owner during an economic recession. Government stimulus measures such as grants, loans, or tax breaks can provide the lifeline to keep your business afloat. These policies directly impact your ability to pay employees, maintain operations, and eventually recover and grow. Consider the impact of regulatory changes on your investments. For instance, stricter banking regulations can prevent risky lending practices, safeguarding savings and investments. On the other hand, excessive regulation might stifle innovation and growth. Understanding these dynamics helps you make informed decisions about where to invest and how to protect your assets. Historical evidence shows that well-designed government policies can significantly enhance economic stability. The post-World War II Marshall Plan aided in rebuilding European economies, helped recover war-torn regions, and stimulated global economic growth. Similarly, the deregulation policies of the 1980s spurred innovation and development, although they also led to increased risks in specific sectors. Governments also play a critical role in regulating financial markets to ensure transparency, fairness, and stability. Agencies like the Securities and Exchange Commission in the United States oversee market activities, protect investors, and maintain orderly market functioning. These regulations help prevent fraud, promote investor confidence, and ensure markets operate efficiently. While government intervention is essential, it must be balanced and well-targeted. Excessive government spending can lead to high public debt, constraining future economic growth and stability. Similarly, poorly designed regulations can stifle innovation and competitiveness. Policymakers must strike a balance between stimulating growth and maintaining fiscal discipline. International cooperation is also vital for economic stability. Global economic challenges, such as trade imbalances and financial crises, require coordinated responses. Institutions like the International Monetary Fund and the World Bank are pivotal in providing financial assistance and fostering international economic cooperation. Consider government policies, rules, and tools that keep the economic engine running smoothly. Just as a well-maintained car requires regular tune-ups and careful driving, the economy needs thoughtful policies and regulations to function effectively. Understanding these policies can help you better navigate the economic landscape and make informed financial decisions. Practical tips for navigating government policies. Stay informed. Follow government announcements and policy changes. Understanding current fiscal and regulatory measures can help you anticipate economic trends. Plan for taxes. Be aware of tax policies and changes affecting your income and investments. Consider consulting with a tax advisor to optimize your tax strategy. Leverage government programs. Take advantage of government programs and incentives, such as grants, low-interest loans, or tax credits, to support your financial goals. Diversify investments. Spread your investments across different sectors and regions to mitigate the impact of regulatory changes and economic policies. Engage in advocacy. Participate in public discourse and advocacy efforts to influence government policies that affect your community and economic well-being. In the next chapter, we will explore global perspectives on monetary systems. We'll compare how different countries manage their currencies and maintain economic stability, highlighting the successes and challenges of various approaches. Join me as we journey through the diverse landscape of international monetary policies, gaining insights that can inform our understanding of global economics and its impact on our financial lives. Chapter 13. Global Perspectives on Monetary Systems. Countries worldwide adopt different approaches to managing their currencies and ensuring economic stability. These strategies reflect each nation's unique financial circumstances, political landscape, and historical experiences. By examining these global perspectives, we can better understand how different monetary systems operate and the lessons they offer. In this chapter, we will explore the monetary policies of various countries, comparing their approaches to managing currencies and maintaining economic stability. We will highlight the successes and challenges of these systems, drawing insights that can inform our understanding of global economics and its impact on our financial lives. Countries like Germany and Japan have successfully maintained economic stability through prudent fiscal policies, robust regulatory frameworks, and a focus on exports. Germany's adherence to fiscal discipline and its role as a critical player in the Eurozone demonstrate the importance of sound monetary policies. Similarly, Japan's approach to managing deflation and innovative economic policies, such as quantitative easing, offer valuable lessons. On the other hand, countries like Argentina and Venezuela have faced severe economic crises due to poor monetary management and hyperinflation. Argentina's repeated debt defaults and Venezuela's collapse into hyperinflation highlight the dangers of excessive money printing and lack of fiscal discipline. These examples underscore the critical role of responsible monetary policy in maintaining economic stability. Imagine living in Switzerland, a country known for its stable currency and robust banking system. The Swiss National Bank's policies ensure low inflation and economic stability, providing a secure environment for savings and investments. This stability contrasts sharply with the experiences of those in countries with unstable currencies, where financial planning becomes a daily struggle. Consider the impact of currency stability on personal and business decisions. In countries with stable currencies, individuals can plan for the long term, companies can invest confidently, and the economy can grow steadily. In contrast, uncertainty prevails in countries with volatile currencies, making saving, investing, or conducting business challenging. Historical data shows the effectiveness of different monetary systems. For instance, the Scandinavian countries Norway, Sweden, and Denmark maintain stable economies through prudent fiscal policies and strong social safety nets. Their experiences illustrate how comprehensive economic strategies can lead to sustained prosperity and high living standards. China's rapid economic growth, driven by state intervention and market-oriented reforms, offers another perspective. The Chinese government's control over its currency and strategic economic planning has transformed the country into a global financial powerhouse. However, this approach raises questions about sustainability and potential risks, such as rising debt levels and trade tensions. While different countries offer various models of economic management, it is essential to recognize that there is no one-size-fits-all solution. Each country's approach must be tailored to its unique circumstances. Additionally, the global economy's interconnectedness means that economic policies in one country can have far-reaching effects on others. For example, the Eurozone's experience with shared currency highlights the benefits and challenges of economic integration. While the euro has facilitated trade and financial stability among member countries, it has also posed challenges, such as the Greek debt crisis, which required coordinated responses and highlighted the need for fiscal solidarity. Think of the global economy as a vast orchestra, with each country's monetary policy playing a different instrument. They create a beautiful symphony of economic stability and growth when played harmoniously. However, if one instrument is out of tune, it can disrupt the entire performance. By understanding how these different policies work together, we can better appreciate the complexities of the global economy and make informed financial decisions. Practical tips for navigating global economic impacts. Stay informed. Keep up with international economic news and trends. Understanding global events can help you anticipate changes affecting your financial situation. Diversify investments. Spread your investments across different countries and asset classes to mitigate risks associated with any single economy. Hedge currency risk. If you have investments in foreign currencies, consider hedging strategies to protect against currency fluctuations. Understand trade policies. Understand how international trade policies and agreements impact global markets and your investments. Consider geopolitical factors. Geopolitical events can significantly influence economic stability. Stay informed about global political developments and their potential financial implications. The next chapter will explore investment strategies for a stable economy. We'll delve into sound investing principles, the importance of diversification, and how to build a resilient investment portfolio. Join me as we uncover the secrets to successful investing in a stable economic environment, equipping you with the knowledge and tools to grow wealth and secure your financial future. Chapter 14. Investment Strategies for a Stable Economy. Investing in a stable economy offers numerous opportunities to grow your wealth and secure your financial future. Understanding sound investing principles, the importance of diversification, and how to build a resilient investment portfolio are vital to achieving long-term economic success. In this chapter, we will explore effective investment strategies that can help you navigate the complexities of the financial markets and make informed decisions. Investing is more than buying stocks or bonds, it's about creating a diversified portfolio that can withstand market fluctuations and provide steady returns. A well-thought-out investment strategy can help you achieve financial goals, such as buying a home, funding your children's education, or ensuring a comfortable retirement. For example, during periods of economic stability, equities tend to perform well as companies grow and generate profits. Investing in a broad range of stocks can provide capital appreciation and dividend income. Additionally, bonds and fixed income securities can offer stability and predictable income, balancing the potential volatility of stocks. Imagine you're a young professional just starting your career. You have some savings and want to start investing for the future. A diversified portfolio can help you grow your wealth while minimizing risk. By spreading your investments across different asset classes, such as stocks, bonds, and real estate, you can protect yourself against market downturns and exploit growth opportunities. Consider the retirees' experience relying on investment income to supplement their pension. By maintaining a balanced portfolio that includes dividend-paying stocks and bonds, the retiree can enjoy a steady income stream and protect their savings from inflation. Historical evidence supports the benefits of diversification and disciplined investing. For instance, the lost decade of the 2000s saw the S&P 500 return to virtually zero due to two major market crashes. However, investors with diversified portfolios, including international stocks, bonds, and tangible assets, still achieved positive returns. Research consistently shows that asset allocation, how you divide your investments among different asset classes, is one of the most critical factors in determining your investment success. By diversifying your investments, you can reduce risk and increase the likelihood of achieving your financial goals. While a stable economy provides a favorable environment for investing, it's essential to remain vigilant and adaptable. Market conditions can change, and unexpected events, such as geopolitical tensions or natural disasters, can impact investment returns. Regularly reviewing and rebalancing your portfolio is crucial to aligning with your financial goals and risk tolerance. Additionally, it's essential to be cautious of investment fads and speculative bubbles. Chasing high returns in trendy sectors can lead to significant losses. Instead, focus on long-term strategies and avoid making impulsive decisions based on short-term market movements. Think of your investment portfolio as a garden. Various plants, flowers, vegetables, and trees create a balanced and beautiful garden that thrives in different conditions. Similarly, a diversified investment portfolio includes a mix of assets that perform well under various economic scenarios, providing stability and growth over time. Practical tips for building a resilient investment portfolio. Diversify. To reduce risk, spread your investments across different asset classes, such as stocks, bonds, real estate, and commodities. Regularly rebalance. Periodically review and adjust your portfolio to maintain your desired asset allocation and risk level. Focus on quality. Invest in high-quality companies with solid fundamentals and reliable earnings. Avoid speculative investments that promise quick gains. Stay informed. Keep up with market trends and economic news to make informed investment decisions. Consider seeking advice from financial professionals. Think long-term. Focus on long-term goals and avoid making impulsive decisions based on short-term market fluctuations. In the next chapter, we will explore the impact of technological advancements on the financial markets. we'll examine how innovations like artificial intelligence, blockchain, and fintech transform investing, and what these changes mean for your financial strategies. Join me as we dive into the exciting world of technology-driven finance, uncovering new opportunities and challenges in the evolving investing landscape. Chapter 15: The Impact of Technological Advancements on Financial Markets. Educational and informative technology is revolutionizing the financial markets, bringing new opportunities and challenges for investors. Innovations like artificial intelligence AI, blockchain, and financial technology fintech are transforming how we invest, trade, and manage money. Understanding these technological advancements is crucial for staying ahead in the evolving landscape of finance. In this chapter, we will explore the impact of technological advancements on the financial markets. We'll examine how these innovations are changing how we invest, the benefits they offer, and the potential risks they pose. Artificial intelligence and machine learning are reshaping investment strategies. AI algorithms can analyze vast amounts of data at unprecedented speeds, identifying patterns and trends that human analysts might miss. This technology enables more accurate predictions and better investment decisions. Robo-advisors, which use AI to manage investment portfolios, offer personalized financial advice at a fraction of the cost of traditional advisors, making investing more accessible to a broader audience. Blockchain technology, the foundation of cryptocurrencies like Bitcoin, revolutionizes how transactions are recorded and verified. Its decentralized and secure nature reduces the risk of fraud and increases transparency. Blockchain has the potential to streamline financial processes, reduce costs, and improve efficiency in areas such as trading, settlement, and payment systems. Imagine using a robo-advisor to manage your investments. You input your financial goals and risk tolerance, and the AI-powered platform creates a diversified portfolio tailored to your needs. It continuously monitors your investments, rebalancing the portfolio to align with your goals. This technology benefits you from sophisticated investment strategies without extensive financial knowledge. Consider the use of blockchain in real estate transactions. Traditionally, buying a property involves a lengthy and complex process with multiple intermediaries. Blockchain can simplify this process by securely recording all transaction details on a decentralized ledger, reducing the need for intermediaries and speeding up the transaction. The adoption of fintech solutions is increasing. According to a report by Ernst & Young, the adoption rate of fintech services among digitally active consumers globally reached 64% in 2019, up from 16% in 2015. This surge in adoption demonstrates the increasing trust and reliance on technology-driven financial solutions. Major financial institutions are also embracing these technologies. For example, Goldman Sachs uses AI for trading and investment decisions, while JP Chase employs blockchain for secure and efficient payment processing. These advancements are transforming financial institutions' operations and setting new standards for the entire industry. While technological advancements offer significant benefits, they also come with risks. The increasing reliance on AI and automated systems raises concerns about data privacy, security, and potential biases in algorithms. Additionally, the rapid rise of cryptocurrencies has led to regulatory challenges and concerns about market volatility. Investors must remain vigilant and informed about these risks. It's essential to balance the potential benefits of new technologies with a thorough understanding of their limitations and the regulatory environment. As technology evolves, staying updated on developments and adapting investment strategies accordingly will be crucial. Think of technological advancements in finance as new tools in a gardener's toolkit. These tools can make gardening more efficient and productive, but they require knowledge and skill to use effectively. Leveraging these tools can enhance your investment strategies and achieve better financial outcomes. Practical tips for navigating technological advancements in finance. Educate yourself. Learn about AI, blockchain, and fintech to understand their impact on finance and how to leverage them in your investment strategies. Use robo-advisors. Consider using robo-advisors for cost-effective and personalized investment management. Stay updated. Follow news and developments in fintech and blockchain to stay informed about new opportunities and risks. Assess risks. Be aware of the potential risks associated with new technologies, such as data security and regulatory challenges. Diversify. Continue to diversify your investments to mitigate risks and take advantage of opportunities across different asset classes and technologies. In the final chapter, we will combine all the insights and strategies discussed throughout the book. We'll outline a comprehensive approach to financial well-being that incorporates the lessons learned and provides a roadmap for long-term economic stability and growth. Join me as we conclude our journey, empowering you to take control of your financial future with confidence and clarity. Chapter 16. A comprehensive approach to financial well-being. As we conclude our journey through the complexities of money and investment, it's time to combine all the insights and strategies we've discussed. Achieving financial well-being requires a holistic approach that incorporates sound monetary principles, effective investment strategies, and an understanding of technological advancements. This final chapter will provide a roadmap for long-term financial stability and growth. Financial well-being is not just about accumulating wealth, it's about managing money in a way that supports your life goals, provides security, and ensures peace of mind. A comprehensive approach to financial well-being involves creating a solid financial plan, staying informed, and being adaptable to changes in the economic environment. Consider the benefits of having a clear financial plan. When you have defined goals such as buying a home, saving for retirement, or funding your children's education, you can create a strategy to achieve these objectives. This strategy includes budgeting, saving, investing, and periodically reviewing your progress to ensure you stay on track. Imagine you are preparing for retirement. You can build a substantial nest egg by starting early, creating a diversified investment portfolio, and consistently contributing to your retirement accounts. Regularly reviewing and adjusting your plan ensures that you can adapt to changes in your financial situation and market conditions, providing security for your future. Consider a young family planning for their children's education. By understanding the costs involved and starting a dedicated savings plan early, they can ensure they have the necessary funds when the time comes. This proactive approach reduces stress and allows them to focus on enjoying time with their children. Historical data and financial research consistently show the benefits of disciplined planning and investing. Studies by financial institutions, such as Vanguard and Fidelity, demonstrate that individuals who create and stick to a financial plan accumulate more wealth and achieve their financial goals more effectively than those who do not. Financial experts agree that critical components of a successful financial plan include budgeting, saving, investing, and risk management. By incorporating these elements, you can create a robust financial strategy that withstands economic fluctuations and supports long-term growth. While creating a financial plan is crucial, remaining flexible and open to adjustments is also essential. Life is unpredictable. Unexpected events such as job loss, health issues, or economic downturns can impact your financial situation. Regularly reviewing and updating your financial plan ensures you can adapt to these changes and stay on course. Additionally, staying informed about new investment opportunities and technological advancements is essential as the financial landscape evolves. Embracing innovation while maintaining a balanced and diversified portfolio can help you navigate the complexities of the modern economic world. Think of your financial well-being as a journey. Just as you would prepare for a long trip by planning your route, packing essential supplies, and being ready for unexpected detours, your financial journey requires careful planning, regular monitoring, and the flexibility to adapt to changing circumstances. Practical steps for achieving financial well-being. Set clear goals. Define your short-term and long-term financial objectives, such as buying a home, saving for education, or retiring comfortably. Create a budget. Track your income and expenses to understand your spending habits and identify areas for saving. Build an emergency fund. Set aside 3 to 6 months' living expenses to cover unexpected financial setbacks. Invest wisely. Diversify your investments across different asset classes to balance risk and reward. Consider using robo-advisors and staying informed about new investment opportunities. Plan for retirement. Start saving early and consistently contribute to retirement accounts. Review and adjust your retirement plan regularly. Stay informed. Follow economic news, market trends, and technological advancements to make informed financial decisions. Seek professional advice. Consider consulting with a financial advisor to create and review your financial plan and ensure it aligns with your goals and risk tolerance. empowering your financial future. As we conclude this journey, remember that achieving financial well-being is a continuous process that requires discipline, knowledge, and adaptability. You can confidently control your financial future by implementing the strategies and insights discussed in this book. The financial world is constantly evolving, but with a solid foundation in sound monetary principles, effective investment strategies, and an understanding of technological advancements, you are well equipped to navigate the complexities and seize opportunities. Your journey to financial well-being starts now, and with the right approach, you can build a secure and prosperous future for yourself and your loved ones. Thank you for tuning in. Hit subscribe to stay updated with cutting-edge content and become part of our vibrant community. Your subscription helps us continue our mission to make learning fun and accessible. Join the conversation below and be part of a movement pushing the boundaries of what's possible. Let's learn, grow, and thrive together. Embrace the adventure of endless possibilities. Be well and thrive.